In this video, I'm going to discuss the Chapter 7 Foundation 15 problem on capital budgeting decisions. And when we look at the problem here, we have Cardinal Company is considering a 5-year project that requires an investment of $2.9 million in a specific equipment, and it has a useful life of 5 years and no salvage value. The company's discount rate is 14%, and the project would provide net operating income as follows. So in this income statement we're seeing right here, this would be a financial reporting type income statement in which we have revenues minus all expenses. And some of these expenses may be non-cash related. So for example, depreciation, even though that's a financial reporting expense, it's not an actual cash outflow. So many times for these type of analyses that we do under capital budgeting, we only want to consider the cash flow effects. Okay, so question number one looks at this, and it says which item in the income statement shown above will not affect cash flows. So from a financial reporting perspective, we have net income of $405,000, but if we were looking at coming up with net cash flows from operations, which is what they're what we need, we would have to back out that depreciation. So for number one, the depreciation of $595 is a non-cash expense. Okay, so that's number one. Number two says what are the project's annual net cash inflows? Okay, so traditionally we'll call these the net cash flows, and then if it's positive, we would say it's inflows. If it's negative, we would say it's outflows. But the net of the positives and the negatives would be whatever the financial reporting income is, which is $405,000 positive, plus any non-cash expenses, which in this case we have $595, and minus any non-cash revenues. Now here, we're going to assume that all these sales are for cash because we're not told otherwise. But sometimes you'll have some of this be sales cash related and then sales on account. So for those sales on account, we would have to reverse that out. But in this case, all we're doing is adding back in the depreciation expense because that's a non-cash outflow. So technically, every period, every year, we expect net cash flows of $1 million. We'll move on to question 3. It says, what is the net present value of the project's annual net cash inflows? Okay, so we could look at it as a timeline, which is what I try to do here. Let me copy this here. Oops, that didn't work out well. 1 second. Okay, there we go. So what we have here is that every year we are going to have $1 million of net cash flows. Okay, so in a timeline we can put it as such because the project is over 5 years. So here we go. Okay, and the way we would get the present value here is we could use a table if you wanted to, or we could just use Excel's feature here where we do the present value of $1 million, and then what we do is we specify the rate per period, the number of periods. So in this case the rate is 14%. We put a comma there, and then it needs to know the number of periods, which in this case is 5 years. The next option says payment, and you would use this option if you have an annuity. But in this case, oh, actually, my bad, this is an annuity. I take that back because we have an equal stream of payments every year. So because it's an annuity, we're going to put in here 1 million. And since we are computing the present value, we ignore this future value. So if you were estimating the future value, you would do a different formula. But here you want to just ignore that, so you put another comma, and then the last option is what type of an annuity is this? Is it a regular annuity, which is the end of the period, or is there an annuity due? Okay, and in our case, we're getting these payments at the end of each period, supposedly. So that's going to be a regular annuity, and you put 0 in there. So when you hit enter, you have that the present value of these 5 payments is $3.4 million. And it by default puts it as a negative here, but technically these are positive cash inflows. So I'm just going to put this as a positive by just adding a negative in there. Oops, maybe not. Maybe I got to add it to the front. My bad. Here. Okay. And this is useful because now when we do the net present value analysis, at least we know what the present value of these cash flows are. And that amount is 3.4 million. Okay? All right, question number 4 is asking us, what is the project's net present value? Okay, so don't confuse the present value. Like, this is the present value of all future net cash flows. Let me expand this a little bit. That's what this is, okay? Don't confuse the present value of all the future cash flows with the NPV of the project. So the NPV, the net present value, is the net of what you have to invest versus what you are getting in return in terms of positive amounts. So what I mean by that is, when we're doing the NPV, we're going to have these positive cash flows in there, but we're also going to include the original investment of $2,975,000. And this one is negative because of the fact that we're investing. Money is going out. Okay? We know what the present value of all the future cash flows are that we did before. So I'm putting that one down. And then the NPV would be the net of these two. Okay, so you would get the net, and if the result is positive, then you have a positive NPV, which means that your return on investment is greater than your discount rate. Recall that when we discounted these cash flows, bear with me here. When we discounted these cash flows, let me find the arrow that I want. That will be this arrow here. And how do I flip this? Oops. My apologies. This is not the arrow I was looking for. 1 second. There we go. So when we discounted all of these cash flows, not just one of them, but all of them, we used a discount rate of 14%. Okay, that's what discount rate they asked us to use. So again, this here is based on a discount of 14%. Now, when your NPV is positive, as it is in this case, what that means is that your return on investment is greater than 14%. Okay, and if this is the threshold that we've put, 14%, and our NPV is positive, then we would say that this particular project is returning more than our minimum investment needed. And the way you gauge whether this is good or bad, at a baseline it's good because we're meeting that basic threshold. But you would also want to compare this to other projects, other investment opportunities. Okay, so you know these numbers are meaningful to some degree by themselves, but they're definitely more meaningful when you compare it to other projects and you compare. Okay. So another way we can analyze the particular project is using the profitability index. So that's what question number 5 is about. What is the project's profitability index? Okay, so I'm going to write in here profitability index is going to be equal to the NPV divided by the investment. And the higher this number is, the better. So in our case, the profitability index is going to be equal to 457,000, or 458 in this case, 081, divided by the investment, which was 2,975,000. Okay, so that we're getting this 458 from our NPV analysis. We color code this just so we can see where things are coming from. And what that gives us is a profitability index of, bear with me here, of around 0.15, okay, if we round it. And this should not be noted as a negative, so let me just put a negative here. It's just a positive number here because our NPV was positive. But since the investment we illustrated as a negative, that's why it came out that way. But technically, we would say here that the profitability index is 0.15. Let me just make this a little bit smaller. Okay, and again, this number by itself is somewhat meaningful, but the value of doing these type of analyses, the capital budgeting comparisons, is to look at other potential investments and compare these values, the profitability index, compare your NPV, etc., to other projects as well. Number 6 is what is the project's internal rate of return. So here's how this particular calculation would work. First of all, let's recognize that if our discount rate is 14% here on the NPV analysis, and we end up with an NPV that is positive, then it means that our return on investment is greater than 14%. Now, the question is then, what is our return on investment? And whatever interest rate you use, whether that be 15%, 16%, whatever it is, whatever rate you use that gives you 0 right here, okay, that is your internal rate of return. Okay, so the internal rate of return, another easy way of thinking about it is, it's the calculation of the actual rate of return on your investment. So far, all we know is that it's more than 14%. Okay, so the way we're going to do that in number 6 is a little bit old tech in the way we're going to approach it, but there is an Excel way of doing it. But first, let me just show you. You find the factor. Okay, so find factor for internal rate of return, and the way you find that is get your investment required, in this case 2.975 million, and then divide it by the annual cash flow. Okay, so in this case that was 100,000. So when I do this calculation, I have 2,975,000 divided by 1 million. Okay, and then what this gives me is a factor of 2.975. Okay, now this is not the most technical thing to do, but this is a number we would go and look up at the present value of an annuity table to see what rate corresponds to that. So if you were to go to a present value of an annuity table and you go down the 5-year mark, okay, so you're going to go down the 5-year present value of an annuity table, and you start looking at what column is closest to this number, what you'll find is that the 20% column has a factor of 2.991. So in a table, in a present value of an annuity table, the 5-year 20% column has a factor of 2.991. What that means is that, if this is the closest we can get to it, then we would say that, the internal rate of return, if we were doing it the opposite way, if we would have done it with a 20% factor, we would have gotten 0 right here. So it looks, and it is, a very low-tech way of figuring out what your internal rate of return is. But that's one possible way, okay? When we were doing this one here, number 4, we said that when we use the discount rate of 14% and we get a positive NPV, then it means that our return on investment is more than 14%. What is it? Well, that's our internal rate of return, which here we're finding is 20%. You could do the formula as well in Excel, which is, here's your internal rate of return, and then the next thing it asks for is the values. So when I go over here and I select this stream of net cash flows, it will understand that the first one is an investment, and then, I mean, it really doesn't matter. For the computation, it's just a mathematical thing. It just sees it as a negative and positives after that. And when we want it to give us the result, we leave this blank and we close this and ask it to give us the internal rate of return of that stream of payments. So if you notice, per Excel, it's 20%, which is the same thing we found over here if we used it the low-tech way. Okay, so the internal rate of return here we found was approximately 20%, and that's what Excel does. Let me see here. See, if you notice, it's not exactly 20%. When you do the internal rate of return calculation with Excel, it gives you the precise number. Whereas with our table, we can only get at an estimate if our factor here is not the same as the one on the table. Okay, so now we move on to another methodology of analyzing these investments, and that one's for number 7. It says, what is the project's payback period? And as simple of an approach as this is a real important one. So what we'll have is maybe a column here that says investment, and then net cash flow, net cash flow, and then unrecovered amount, or however you want to call it, here. So when I do this computation, we basically see how long it takes us to get our money back. This is year number 1. In year number 1, we had to put in $2,975,000, and then that's at the end of that year we recovered $1 million. So the amount that remains unrecovered is that difference. So I'm going to go in here and say this minus this. Actually, I should have just put plus, sorry. Okay, so at the end of year 1, we still have not recovered our full investment of 2.95. Second year comes around, we get another 1 million. So then we say, okay, we have this plus this recovery. Okay, we still have left $975,000 to recover. So by the end of the 3rd year is when we're going to have fully recovered the investment that we have here. Okay, and it's going to be a little bit before the end of the year, because here's where it becomes positive, right? And if you wanted to do an exact calculation, you could. You know, it's not a big deal. You just say by the 3rd year we will have recovered this investment. And if you wanted to be exact, then you would say, well, what is 975,000 out of that million? And that gives you that partial year. So you know it's 2 years and change, right? So it's going to be 2 years plus 975,000 out of here. I can put the whole thing. 975,000 out of $1 million for that 3rd year. And what you end up finding is that, you know, it's going to take you 2.98 years roughly to get your money back, and that's the payback period method. So if you notice, we've used quite a few different methods here just to look at this particular investment proposal. We've analyzed the present value of the net cash flows, and a step up after that was just the net cash flow method. We also used the profitability index method, which gave us a value of 1.15. And then we looked at the internal rate of return and noticed that this investment proposal is giving us a 20.24 rate of return, a return on our investment. And then finally, we looked at the payback period and noticed that it takes us approximately 3 years to get our money back. So what this means is that we're going to put every investment proposal under this same line of testing and then compare among all the proposals. In this case, we're only looking at one, but that's the way we would approach this with multiple proposals. And then finally, we have the project's simple accounting rate of return. Okay, so let's do that one as well. So in number 8, we're being asked, what is the project's simple rate of return? Okay. And sometimes this is referred to as the accounting rate of return, different names for it. But basically the idea here is, let's take the financial reporting information of $405,000. Okay, so let's call this the rate of return. Let's take the net operating income per period, and then subtract that by our investment. Okay, so in this case, the simple rate of return would be $405,000 per our financial report here. So we include non-cash expenses, we include non-cash revenues if there were any, which in our case there weren't, and then we subtract by $2,975,000. And that gives us 13.61%. Okay? Now, as I've said before, on its own, this 13.61% is not as valuable as if we're comparing it to other proposals. In a business, we have many opportunities, right? And what we do is we get all these opportunities and we compare them before we put money into them and run them through all these tests that we're doing right here and many more possibly to determine which one is the best overall for our company. So these are metrics that we use to determine what's our best option. All right, let's go look at number 9. Number 9 says, if the company's discount rate of return, or I'm sorry, if the company's discount rate was 16%, would you expect the project's NPV to be higher than, lower than, or the same as your answer in number 4? And they don't want us to do any computations. So I'm just going to show you here. So let's do 9 NPV if discount rate is 14%. So let's copy this right here. Bear with me here. So this is what we had for number 4. So I'm just going to put it down here. We had an NPV of $458,000 with a discount rate of 14%. We also learned from another problem that the internal rate of return was around 20%. So in other words, if we would have discounted these $1 million at 20%, the amount that we would have gotten here is roughly 2.975, which means NPV would have been 0. Okay? So what they're saying is, or what they're asking, I'm sorry, is the NPV, this number right here, the blue one, going to be higher or lower when we use 16%? And if your answer is lower, then you're correct. So the NPV would be lower with discount rate of 16%. I just noticed that I wrote this incorrectly. This should have been 16% right here as they asked. Okay? So what is the NPV if the discount rate is 16%? Well, the NPV would be lower, and to be more specific, lower than 458,081. Now, we also know that it will be positive because to get this to be 0, you would have to use a 20% discount rate. So it's going to be some number positive, maybe 200-something thousand positive. And that's just mathematically what would happen, okay? All right, number 10, if the equipment had a salvage value of 300,000 at the end of the 5 years, would you expect the project's payback period to be higher than, lower than, or the same as your answer in number 7? So recall that in numbers, well, let me first write this down. 10. Payback period if we have a salvage value of 300,000. So in other words, now we're going to recover 300,000 at the end. So the last cash flow is not only going to be $1 million, it's going to be 1.3 million because we'll be able to sell the equipment. So the question is, will that have any effect on our payback period? And the answer is no. It'll be the same because of the fact that we're recovering this within the first 3 years. Okay, so that payment, that extra payment that we're going to receive in the 5th year is irrelevant in terms of this particular analysis, right? Now, is it better for purposes of the internal rate of return? Yes, that would, it would be more than 20% if we have more money coming in, and it would affect the present value of those future cash flows as well. All right, it would affect as well, your a simple rate of return potentially as well, and it would just be better for other metrics. But for the payback period, it would have no effect, given that we're recovering the investment within the 3rd year. All right, let's go to number 11 here. 11 says, if the equipment, oh, here we go, that's what we were just explaining. If the equipment had a salvage value of 300,000 at the end of the 5 years, just like what we just said, would you expect the project's NPV value to be higher, lower than, or the same? So we would expect the NPV to be higher, simply because a larger cash flow here would translate to a larger present value of those net cash flows, which means that this will be higher. And that's what we're doing right there. Okay, they didn't want us to do the computations, but if you wanted to, you could just see how it would change. So let me do that. It doesn't take us any long time here to do this, given that the formulas are already in place. So I'm going to put this as 1,300,000, and then the moment I hit enter, if I did this correctly, this should be higher than 458. Well, of course not. What do I do here? Oh, my bad, because this right here, the formula right here, is just present value of the annuity. We would have to do the present value of each one of these independently to be able to get that. So I could do, just to the sake of completion, I'm going to do the present value of 4 payments of $1 million, plus I'm going to also do the, or in this case minus, so it ends up being positive, minus the present value of 1 payment over 5 periods. Okay, don't get confused here. This is now the 5th period, and this is going to be 1 payment of 1,300,000. Actually, hold on a second. 14%. This is 5%. I'm going to skip the payment here, okay, because of the fact that this is not an annuity. This is just 1 payment, and then I'm going to use this future value in order to compute the present value of that 1 payment. So that's 1,300,000. 1, 2, 3, and then this is still the end of the period. And then when I hit enter, you'll notice that my NPV went up to $613,000. In other words, this extra $300,000 mathematically makes this larger, and hence makes this particular NPV larger. Okay? All right, number 12 says, if the equipment has a salvage value of $300,000 at the end of the 5 years, would you expect the project's simple rate of return to be higher, lower than, or the same? So for number 12, the rate of return is higher because of that salvage value. And the reason being is that that extra salvage value, let me go to the income statement. That extra salvage value would decrease the depreciation over the life of that asset. Okay, so in other words, we would not have to depreciate that $300,000 that supposedly we're going to recover at the end of the period. Whereas this computation here assumes that we're depreciating $595 every period for 5 years instead of an amount that would exclude the $300,000 of recoverability. And just so you can visualize it a little better, this 595, if you were to multiply this times 5, you would get the 2.975. In other words, we're depreciating 1/5 of that 2.975 every year because we had no salvage value. But if you had a salvage value, you would have to get the 2.975, subtract out the salvage value of 300, and then divide by 5. That would result in a depreciation amount every year that would be smaller than 595, and hence why the rate of return would be higher. A smaller depreciation results in a higher operating income, which ultimately results in a higher rate of return. Okay? Let's look at number 13. 13 says, assume a post-audit showed that all estimates, including sales, were exactly correct except for the variable expense ratio, which actually turned out to be 45%. What was the project's annual net present value? Okay, so for this purpose, it might be nice to recreate that NPV analysis. So NPV, we're going to compute the NPV assuming the variable expense ratio and with, relative to sales, okay, that's what they're talking about, is 45%. So we're going to have a higher expense. So let me go ahead and bring back this NPV analysis. Let me set it up and then I'll start the video again. Okay, so here I just brought back the information that we had from before. Recall that when we did the NPV analysis, our net cash flow was negative 2.9 at the beginning and then 1 million after that at the end of each of the 5 years. So I recreated that same thing over here, except I put in the details of what we were given. So sales we were given were 2.735. Variable expenses we were told were $1 million. And just to understand what that amount is, what the ratio is, we would do what's 1 million divided by the sales value. So before, they didn't tell us this, but before basically they were saying that variable expenses were 37% of sales. So now the only thing we're going to be doing is we're going to be changing that to not 37% but 45%, and we're going to see how this is affected. Okay, so let me go ahead and put a formula here on all of these. And if you notice, I did that for every year, the same information that was given to us. So if I come over here and I change this, bear with me here, if I change this to it be our sales times 45%, then, and let me put that as negative, then all they're telling us is, what if our variable expenses go up? Okay, and if our variable expenses go up, well, obviously our net cash flow will go down, which ultimately means that the present value of those future cash flows goes down. So let me go ahead and do that for the whole 5 years. And this is what happens. And this, since I typed it in, it's not programmed, so I just have to type it in. So now it's the net cash flows is 769,250. And when we do that computation, what we see is that if we use a discount rate of 14% as we originally thought, then our NPV is negative, okay? And what does that mean? That means that if our NPV is negative based on these cash flows, then this investment proposal is not meeting the minimum 14%. the return on investment here is going to be much less than 14%. And if you wanted to look at the internal rate of return, in other words, you want to figure out how much we're actually making, we can do the internal rate of return computation. Select your cash flows here, and then close this and let it guess. And basically it's saying that if we were to take on this particular investment, we would be making roughly 9%, which is way lower than the 14% that we are required. Okay? All right, let's look at question number 14. So this is now starting to be what if analysis. 14. Assume a post-audit showed that all estimates, including total sales, were exactly correct, except for the variable expense ratio, which actually turned out to be 45%. So in other words, 13, 14, and 15 are the same information, except now for 13 we did the NPV, for 14 we're going to do the payback period, and then for 15 we're going to do the simple rate of return. So let's go ahead and do that. So for this one, payback period with variable expense ratio of 45%. Oops. So we should be able to do this pretty straightforward. I'm going to bring back the setup we did for payback period here, and you should have picked up on that, on the fact that now it's going to take us longer to get our money back, okay? Because every year we're going to only get this amount right here, 769. And if we go down, oops, I shouldn't have done that, that's for sure. Okay, so what you see is that by the third year, we still have not recovered our money. So now we got to go into the fourth year and say, in the fourth year, we're going to have a positive cash flow, 769, 250. And by that point, we will have recovered, because now it's positive, our initial investment. So with increased expenses, obviously it's going to take us longer to get our money back. And to be specific, it's going to take us almost 4 years, okay? And again, if you wanted to know exactly, you would take 667 divided by 769, and that gives you the partial amount of that fourth year. And then finally, number 15 says, what is the rate of return, the accounting rate of return with variable expenses of 45%? Well, that's going to be a lower return. If you remember, our rate of return, where did we do that computation here? Our simple rate of return ended up being 1361%. That was based on net operating income of 405, which, if you recall, included the depreciation amount that was taken out. Now, if our variable expenses are going to be higher, then our operating income is going to be lower. So let's go ahead and figure out what that would be. So let's do a partial income statement here. Let me get some of this information. So let me just copy this here first. And I'm going to call this net operating income. Ignore this right here, and then all I'm missing here is depreciation, right? So I'm going to include depreciation. And that was minus 595, which means that if we compute the net operating income with the new variable expenses, our net operating income goes from 405 to $174,000. So our rate of return here will be equal to 174,250 divided by the original investment of 2,975. Okay, and that equals 5.86%. So obviously, you know, more expenses, less net income, a less return on investment, and that's what ended up happening right here. Okay, this concludes the video on capital budgeting decisions and analysis.